Most people believe the stock market is a fair system. You invest your money, companies grow, and over time, your investments increase in value. At least, that's the story most people are told. But what if the stock market isn't as simple as it seems? What if behind the charts, the headlines, and the daily price movements, there is a hidden game happening in the background? A game played by institutions, large investors, and powerful financial players who understand something that most individual investors never see. And the most surprising part is this: it's not illegal. It's not even secret in the traditional sense. The rules of the game are visible. But most people simply don't understand how the system actually works. And because of that, millions of investors enter the market every year without realizing the forces that truly move prices. The story most people believe when people first learn about investing, they are usually told a very simple story. If a company performs well, its stock price goes up. If a company performs poorly, its stock price goes down. In theory, the stock market reflects the real value of businesses. But in reality, markets are influenced by far more than just company performance. Prices move because of liquidity. They move because of investor behavior. They move because of large institutions adjusting positions. And sometimes, they move simply because of how the financial system itself is structured. To understand this hidden game, you first need to understand who actually moves the market, because it is rarely individual investors. Who really moves the market? Most individual investors imagine the market as millions of people buying and selling stocks. And technically, that's true. But when you look at the actual scale of the financial markets, something important becomes clear. The majority of trading volume does not come from small investors. It comes from large financial institutions, investment banks, hedge funds, pension funds, asset management companies. These institutions control enormous pools of capital. When they move money, markets move with them. A single large fund adjusting its portfolio can shift the demand for a stock more than thousands of small investors combined. This imbalance of capital creates the foundation for the hidden game inside the market, because large investors don't just participate in the market, they shop it. The advantage of information. One of the biggest advantages large investors have is information. Institutional investors have access to teams of analysts. They study economic data. They analyze company reports in extreme detail. They monitor global markets, interest rates, and economic trends. But the advantage isn't just information, it's also speed. Institutional trading systems can react to information in milliseconds. Algorithms scan markets constantly. Orders are executed almost instantly. Meanwhile, individual investors often react hours or days later. This difference in speed can create opportunities for large players to position themselves before the rest of the market reacts. And over time, those small advantages compound. The role of liquidity, another key part of the hidden game, is liquidity. Liquidity refers to how easily assets can be bought or sold in the market. Large investors often need liquidity to enter or exit positions without dramatically moving prices. Because of this, institutions sometimes build positions slowly over time. They accumulate shares quietly. They spread trades across different markets. And sometimes they wait for moments of high trading volume to execute large orders. From the outside, these movements may appear random. But behind the scenes, they're often carefully planned strategies. How market sentiment is shaped. Market prices are not driven by numbers alone. They are heavily influenced by psychology, news headlines, economic reports, investor sentiment. All of these factors influence how people behave in financial markets. Large investors understand this very well. When markets become optimistic, more investors rush in. When markets become fearful, many investors rush out. These emotional reactions can create powerful price movements, and institutions that understand market psychology can often position themselves ahead of those reactions. The power of long-term strategy. Another difference between large investors and individual traders is time horizon. Many individual investors focus on short-term price movements, daily gains, weekly trends, quick profits, but many large institutional investors operate on much longer time. They build positions over months, sometimes even years. Because of their size and patience, they can absorb short-term volatility that might scare smaller investors out of the market. And when smaller investors exit during periods of fear, institutions often use those moments to accumulate assets at lower prices. This cycle happens repeatedly throughout financial history. The impact of money flows. One of the most powerful forces in the stock market is not news, earnings, or even valuation. It is money flows. When large amounts of capital enter the market, prices tend to rise. When capital leaves the market, prices often fall. Institutional investors manage massive amounts of money on behalf of pension funds, retirement accounts, and global investors. When those funds allocate capital to certain sectors, the price impact can be significant, and sometimes these flows occur for reasons unrelated to the underlying companies. Portfolio adjustments, risk management strategies, interest rate changes. All of these decisions can move markets in ways that individual investors may struggle to anticipate. How market structure gives advantages. Another part of the hidden game in the stock market is the structure of the market itself. Financial markets today are extremely complex systems. They involve multiple exchanges, electronic trading networks, algorithmic strategies, and institutional trading platforms. Large institutions often operate within this structure using tools that individual investors rarely access. They can split orders across different exchanges. They can execute trades gradually to avoid moving the market too quickly. And they can use algorithms designed to find liquidity across the entire trading system. From the outside, these transactions may look like normal market activity, but behind the scenes, there is often careful strategy involved in how large positions are built or reduced. Understanding this structure helps explain why price movements sometimes appear sudden or unpredictable. In reality, they are often the result of large capital flows moving through a complex financial network. The role of market cycles. Financial markets also move in cycles. Periods of optimism are often followed by periods of fear. Bull markets attract new investors. Prices rise steadily. Confidence grows. More people begin investing as they see others making profits. But eventually, conditions change. Economic growth slows, interest rates rise, or unexpected events disrupt markets. At that point, sentiment shifts. Investors become cautious. Prices fall, and many individuals exit the market during these periods of uncertainty. Yet historically, these moments of fear are often when large institutional investors begin accumulating positions again, because they understand that market cycles repeat over time. This pattern has appeared again and again across decades of financial history. Why? Patience matters in the market. Another difference between large investors and individual investors is patience. Institutional investors often build strategies based on long-term market trends. They understand that short-term volatility is part of the system. Individual investors, on the other hand, often react emotionally to short-term price movements. A sudden drop in prices can create panic. A rapid rise can create excitement and fear of missing out. These emotional reactions can lead to buying at high prices and selling during downturns. Meanwhile, investors with longer time horizons may view those same fluctuations as opportunities. This difference in perspective is one of the subtle ways the hidden game of the stock market unfolds. The importance of understanding the system. The goal of understanding the stock market is not to assume that large investors are controlling every movement. Markets remain complex and unpredictable, but understanding the forces that influence prices can change the way investors interpret what they see. Instead of reacting to every daily fluctuation, investors can begin to recognize larger patterns. They can understand how liquidity, capital flows, and economic policy influence market behavior, and they can begin to view the market as a dynamic system rather than a simple price chart. This shift in perspective is often what separates experienced investors from those who approach the market without understanding the broader system. The role of the financial system, the stock market, does not exist in isolation. It is deeply connected to the broader financial system. Interest rates influence borrowing costs. Central bank policies influence liquidity. Economic conditions influence corporate profits. When central banks lower interest rates, borrowing becomes cheaper. This often pushes investors toward riskier assets like stocks. When interest rates rise, the opposite can happen. Investors may shift capital towards safer assets. These large shifts in capital allocation can create powerful trends in financial markets. And understanding these forces is one of the keys to understanding the hidden game inside the stock market. Why most people never see this? The reason most investors never fully understand this system is not because the information is hidden. It's because the financial system is complex. The forces shaping markets operate across many layers: institutional capital, economic policy, investor psychology, global financial flows. When someone looks only at stock charts, they are often seeing the final result of these forces, but the deeper mechanics remain invisible unless you step back and examine the system as a whole. Conclusion: the stock market may appear to be a simple place where investors buy and sell shares. But beneath the surface lies a far more complex system. Large institutions move enormous amounts of capital. Market psychology influences behavior. Global financial flows shape demand, and economic policies quietly influence the direction of markets. Understanding these forces does not guarantee success in the stock market, but it does reveal something important. The market is not just a collection of individual trades. It is a system shaped by powerful financial forces that most people never fully see. And once you begin to understand that system, the behavior of markets starts to make a lot more sense.